All right, let's go. We're dropping you right onto a live trading floor, just moments before the real action kicks off. You can feel the energy building, the charts are alive, and a day's fortune is about to be made or lost. So let's jump in and decode what's happening. And boom, right out of the gate, you get this quote from the floor, and it perfectly captures the heart of trading. The news is bad, so your brain says the market should be going down. But it's not. It's going up. It's this kind of crazy backward logic that we are going to break down today.
So how in the world do you navigate that kind of chaos? Well, it's not about guessing. It all starts way before the opening bell with a solid plan. For today, the strategy is already set in stone, and they're calling it high to go low.
So here's the setup for the day. Earlier in the morning, a big economic report came out, the ADP non-farm employment numbers. And honestly, they weren't good. But the market? It barely budged. It's just sitting there, coiled like a spring. You can tell everyone is just holding their breath, waiting to see which way things break when that opening bell rings.
You know, this pre-market prep isn't just a quick glance. It's a whole process. They're looking at what happened overnight, they're factoring in that bad economic news, and then they're mapping out the most important price levels for the day. And all of that data leads them to one specific bias. They expect the market to pop up first, hit a peak, and then sell off. So the plan is to short it, to bet against it from that high point.
Okay, to really follow the action, you've got to speak the language. It might sound like some kind of secret code at first, but it's really just a way to map out the day's battlefield. So let's crack this code together. You're going to hear these two terms thrown around constantly on the floor. R1 and S1. They're the absolute cornerstones of a trader's daily map. So what exactly are they?
Think of resistance, or R1, as a price ceiling. It's this level where the trader's plan says, hey, a bunch of sellers are probably waiting right here, and that selling pressure is likely to stop the price from going higher and push it back down. For their high-to-go-low plan, this R1 level is the bullseye. It's exactly where they want to sell. And if R1 is the ceiling, then you've got support, or S1. That's the floor. It's a price level where buyers are expected to show up in force, stop the market from falling any further, and maybe even make it bounce. So these two levels, R1 and S1, basically draw the sandbox they expect to play in for the day. There's one more piece of jargon they use, basis pressure. Just think of it like their own private weather forecast for the market, based on some special zones on their charts they call magic bands. And for today, that forecast is calling for downward pressure. This just gives them another layer of confidence that their plan to sell from a high point is the right call.
Okay, the homework is done. We know the lingo. The market is officially open. Now we get to see if the plan actually works. The pace picks up and everything starts happening in real time. And bam, it happens almost instantly. The market shoots up, taps that pre-planned R1 resistance level, that ceiling we talked about, and then immediately reverses. For any trader who stuck to the plan and sold right at R1, their work for the day could literally be over. One and done.
And just look at the result. One trader on the stream shorts the market from a high of 540. The market tumbles, and in just a matter of minutes, they've banked a 100-point move. That is a huge, super fast profit.
And the sell-off doesn't stop until the market hits that predefined floor, the S1 support level. And what happens? It bounces right off it. The entire move they planned for this morning has just played out, picture perfect. R1 was the top, S1 was the bottom. The plan worked. So after that big, exciting burst of action, things kind of quiet down. The market starts consolidating, which just means it's chopping back and forth, moving sideways. The obvious big move of the day is over. And for the traders on the floor, this lull is the perfect time to switch gears from trading to teaching. So with the market just chopping around, the vibe on the floor changes. An experienced mentor starts walking a new trader through the ropes, and we get this amazing peek behind the curtain at the business side of becoming a pro.
I mean, this is the big question, right? How do you do this without betting the farm? Well, the answer for a lot of people is something called a funded account from a prop firm. Basically, it's a way to prove you can trade, and if you can, a company gives you their capital to trade with, not your own. Now, the traders talk about a couple of different firms, but the real lesson here is that you have to read the fine print. They might seem similar, but the most important rule, the make or break rule, is the drawdown, which is how they measure your losses. A firm like Take Profit might set your max loss limit at the start of the day and leave it there, but others like Bullnox use what's called a live trailing drawdown, and that's way trickier. It's like your stop loss is on an escalator. As your profits go up, your maximum loss level follows you up, which makes it way easier to fail out if the market suddenly swings against you.
So we've seen the strategies and the business models, but you know what really makes the difference between success and failure in this game? It's all about your mindset. The final lessons from the floor aren't about charts at all. They're about psychology. This might just be the most important advice of the entire day. It means you have to react to what the price is actually doing, right there on your screen. Don't trade based on what you hope will happen or what you think should happen. You've got to get your ego and your predictions out of the way.
And they make it really clear there's not just one right way to trade. You've got scalpers who are in and out of the market all day, making tons of tiny trades for small, quick profits. Then you've got position traders who might wait patiently all morning for that one single, perfect setup at a big level like R1. The real secret is figuring out which style actually fits your own personality. And here it is. This is the golden rule. The secret to staying in this game isn't finding more winners. It's about controlling your losers. A stop loss is your eject button. It gets you out of a bad trade before it gets really bad. You have to be okay with taking small, planned losses, because that's what prevents the big, catastrophic one that blows up your account. Which brings us right back to the beginning, but with a totally new way of looking at it. We've seen the plans, we've learned the code, we've watched the trades, but what it all comes down to is this. After all the analysis is done, you realize the final boss in trading isn't the market. It's the person staring back at you from the screen.